First thing, we have to say our disclaimer, and that is that investing in cryptocurrencies is a high risk investment. Trading on margin carries a high level of risk and may not be suitable for all investors. Before you decide to trade crypto, be careful. Consider your investment objectives, your level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with cryptocurrency trading and seek advice from an independent financial advisor if you have any doubts. Also, Binance has not necessarily started this program. This is South African Binance Angel endeavor, and it's to create engagement in the group. It's for educational purposes, and we do not do trade calls specifically. To recap on what we did on the last 2 weeks, we went through what is a market made up of. So all markets are made up of buyers, sellers. In cryptocurrency, we have hodlers or holders of currency. And we also have market makers and liquidity providers. In our case, in order to trade the markets, we need to understand who the players are and what makes markets move. So we have miners. And in general, miners are those that provide Bitcoin to the market. So exchanges have to buy Bitcoin from miners, which in turn turns miners into basically the larger sellers of Bitcoin. This provides almost a constant sell pressure at certain points. So it's something that we want, a metric that we need to look at. Whales are those with over 1,000 Bitcoin in their ownership. They don't have a permanent bias. The belief is that they're generally selling high and buying low to increase their Bitcoin stack. Exchanges are also market players. Generally, they would be buying Bitcoin from miners. There are funds who are going to hold Bitcoin or for whatever reason trade Bitcoin. There are institutions, and then there's us retail guys right at the bottom. Where do we start then? The $1 million question is we have to know how markets work. There are buyers, sellers, and a matching engine, and that's as simple as it is. And we'll get into the next bunch of things where we talk about technical analysis and indicators and stuff, but markets certainly don't move because you applied an indicator. At the end of the day, it's always between a buyer and a seller. And in an exchange side, we can have an engine that matches the buyer to the seller. We're always in a price discovery moment at any given time of the day. I'm hearing a mic.
Midzalia air base there. Where you go, you wear the suit there. Those suit. Then the blow the air, then it's floating. You don't want to do that. Huh?
I'm going to mute. Okay. Sorry. Moving on, we get, now that you know the simple process to a trade, you can make millions. It's simply not that easy. Although simple to place trades, it's not easy to make profits out of the market. If you've tried before, you won't argue with me on that point. If you think it's easy, you're probably on the road to find out that it's not that easy. You need to find an edge. Sorry, someone again. Okay. So the rules of trading is that you must always do what the smart money does. In our case, that's going to be whales, funds, or institutions. Generally, people who have the clout to be able to move the market. How on earth could we win against that? It is possible, and I don't need to pull up a chart to prove that. Actually, it's more about if you are willing to discipline yourself, or willing to how can I say, at least open yourself to discipline. The other swear word is patience. One must be open-minded. And if I could sum that whole line, it's probably to think in probability, which means if this, then that, if that, then this. And it's never saying that the market will do something. The market can do whatever it wants to do. We need to prepare ourselves to change direction either way. We won't go to a chart right now, but the first session, which I'll post this links under this video when I post it. We spoke about the price action method, support, resistance, trend lines, and time frames. That's the building blocks of any chart. And once again, we did speak about that in the first video, and the second video also covered it again. Lesson 2, which was last week, is we went price action on the charts again, how to gain an edge in trading, and how it applies to trading in general, because everything that we're showing you here, you can literally apply to every market. Yes, there's something that's unique to crypto, but crypto moves at a much faster pace than most markets, so you can always work your way back to trading forex and stocks and stuff like that. So the big question is always, does technical analysis work? We will be doing a bit more baby steps webinars as well, because I will admit that this is sort of almost light speed if you have never touched trading yet. So technical analysis is simply the financial analysis that uses patterns in market data to identify trends and make predictions. And this is looking for repeatable patterns and repeatable situations that we can predict price behavior after that. It is a bit of voodoo sometimes because, I mean, just lines on the chart, why would any market care? And it doesn't actually need to adhere to it, but you find over time that with more market players, it tends to behave in a certain way, and we can see that. I'm sure if you've been in trading a while, you've seen some of these patterns or heard of them. The most popular ones being head and shoulders, double tops, double bottoms. Obviously the inverse of that. These ones are a bit harder to see in real life because the market doesn't, how can I say, yes, that is the pattern, but it doesn't always present itself exactly like that on a chart. It's not always so neat. We then moved on to indicators. It's a very broad area and we'll never be able to cover them all in one session, but we will. I mean, we have lots of time. Every week we can do something. The more important thing is to always determine what is the market structure. Is the market trending? Is it consolidating? And trend, I mean both up or down. Consolidating obviously means price is stuck somewhere. I'm hearing sound somewhere. Sorry, I'm just gonna mute. If you want to ask a question, just unmute yourself and ask. But I mean, I prefer just stay muted for now. Does technical analysis work? It's hard to say that it emphatically works all the time because trading is very much about the bias that you come with, and also we're very subjective in how we look at things. So one person might see the head and shoulders and be adamant that it is, and another person just doesn't see it and maybe the person that's selling 10,000 Bitcoin doesn't care whether it's head or shoulders. They just need to sell it at that point in time. So we must always be prepared to admit quickly we're wrong, get out of a trade, or look at a chart and take advantage of something. So there's generally three categories that all technical indicators will fall into. And one is trend. The most common one we'll see is moving averages, the MACD, and the parabolic SAR. The other kind of indicator that we have is the momentum one, which is generally looking at the strength of something, not necessarily showing direction. This one is probably more a stock indicator than anything, but a stochastic oscillator, the RSI, which we will use, the CCI, not necessarily always a crypto indicator. The other one is volatility, and this is measuring sort of major moves, the width of the market, so the high and the lows are wider. And we're looking at things like Bollinger Bands, average through range, and standard deviations. This is where I wanted to focus a bit today. And yes, it is probably a bit of the boring stuff, but one must have a risk management or money management process if you're going to place trades. And that normally starts with the very first question of how much are you willing to lose? You must never ever approach the market with how much I'm going to make, because for one, there is no guarantee that you're going to make it. But you can be certain that you are willing to lose, let's say, $10 in a trade. That's fine. And you can place that trade knowing that you've committed to that before. If you make money, great. If you lose, you already committed before and that you're willing to lose. What we do have to do over time is that we have to realize that if we stick to our trading plan and we systematically place the same type of trades all the time, we must make sure that the reward that we want is bigger than the risk that we take. So if we're trading $10, our aim should be to make 10 or more dollars. So if we go 10 and we're risking 10, then that's a 1-to-1 risk reward. If I'm risking 10 but wanting to make $20, that's a 2-to-1. Now, you'll get better at this along the way, but the normal average should be about 3-to-1. So we want to make $30 for every $10 we risk. That way, over time, the averages will mean that even if you win, I think it's 40% of the time, you will still be making profit. Every one of these markets have very different risk profiles. So margin, well, especially margin in futures, because you're using leverage, it's a very different environment, and that will be dealing very last. For now, if we're doing basic trading, I would always say stick to spot. It doesn't matter if you're not making a lot of money. There's a whole lot less risk on the table when we're only trading the spot market. Now, in the spot market, I don't think we have stop losses yet. But it is always good going into a trade knowing that if it hits a certain level, I'm wrong. Rather get out of the trade then. Also, going into the trade, I know where I want to get out also. Now, I know we're a bit spoiled in crypto in that we can easily expect 100% return on any altcoin. It's not always the case, but 20, 30, 40% is easily achievable on an altcoin. Not necessarily on Bitcoin and Ethereum, but it certainly is doable. Then you have to ask yourself, what are you wanting to achieve by trading in crypto? Are you wanting to grow more Bitcoin? Are you wanting to grow dollars or rand? You must sit down and decide this beforehand, because I must admit, even though I'm a Bitcoin person, I honestly trade around the dollar price more often than anything, because Bitcoin is a very hard measuring tool unless you stick to it almost exclusively. So if I just want to stack sats, I need to discard the USD amount of it and stick to the alt pairs. The problem sometimes is that they're not always as liquid. So a lot of people on the other end are wanting to build their dollar base. So there's a lot more liquidity on the dollar side, or Tether for that matter. Before we head to the charts, I also wanted to speak about Fibonacci. Now, that's a very big let's just jump here. Fibonacci is a very big topic in trading, and largely I would say the reason why Fibonacci is important is because everyone else believes that it works. And I know that's not very helpful. It's actually rather funny, but and because cryptocurrency is filled with a lot of new traders, I would say it's very technically obedient. And let's go to a chart and use Fibonacci on there for that matter. If you want to see what every indicator looks like, it's best to go and view last week. So the most common way of using Fibonacci retracement tool is to you look at, right now we're on a 4-hour chart. So if we take the bottom of something and we stretch it up, okay, I forget, you need to actually pull it from there, and we pull him up to the top of that run, you just let go. You just double click it, so you're switching it off so we can't drag it around. And then you'll see, so the rule of Fibonacci is that because we've picked that up move there, if we go back down to this line, it's considered just a retracement. We look for resuming of trend. It doesn't mean, however, if we come down to the 38% line, that it's a reversal. This could still be just a correction in the up move and move on again. Once we hit the 50 level, things aren't looking too great. But usually the Elliott waves guys, they love Fibonacci. But like I say, if you look at this, that's the normal way of looking at things. You can see that there is definitely some level of respect around there. In this case, we wouldn't have had it on here up until we reached that high. And you can repeatedly do this if you just want to test. You pick the bottom, click, drag, and let's do that. In this case, let's delete that one. And I want you to see how it reacts around the different levels. So you'll see there, we came down, it bounced up. It sort of almost disregarded the 38, but it hit that 50 to the T and it bounced up. Obviously, the next week it just didn't care. And equally, if we're trading downtrends, we can then reverse the process. So once again, we take the top there, we drag him down. It's like it hates me. If you want to know what the red lines are that we spoke about on the first session, we drag him more to the side here. Let's just, doesn't seem to want. I can just extend that yellow lines. So now if we're trading down, we're looking for reversals down. And in this case, I just ignored them all. So don't use it that way. It's very important that one sort of frames it around what the trend is and what time frame you're on. If we go to the daily, it's a very different outlook. We do the same. We take from the bottom, pull it to the top. Went up to the top, came down to 38, went up again, down almost to 61, up again, down to 61, up again. And if it doesn't respect lines like that, you can just ignore Fibonacci. And I wouldn't say it's your only thing that you should. There's many ways to use Fibonacci numbers, and the retracement isn't necessarily the easiest one to trade. So I wouldn't recommend that you go along that route. But I wanted to show you the risk to reward, how it would look on a chart, and I think it's easier to do that on TradingView. I know I'm jumping a lot to different things, but it's just how I do things. I'm trying to full screen. So let's say we put in a sell order. It's swearing. It's just not doing. So because we've got a resistance line here, and I, for argument's sake, wanted to sell here, I need to get to my viewer. Sorry. And let's say I placed a short there. I would want to put my stop there. And I'd want to take profit there, more or less. And we can see that just that length, it's about 1.5. So we're risking, let's say that's $10, we're wanting to make $15. That's at least looking at this chart, and that's what I would want to do if I'm going to short it. Because we see last week here, it also just didn't win here. So it stands to reason that if I'm going to short here, I would consider myself wrong above there. And if I were to wait completely and be more certain, I'd probably wait until it hits that level and only short it when it gets there. If I'm risky, I short right now. That's obviously if I'm shorting. If I'm deciding to go long, it would look very different. If market came down here, I would be making a long trade there, and I would place my stop there. And in this case, I'd want to get out there. So entry would be around 130, and I'm risking whatever $10 will get down there, and this would be margin trades. And in this case, it's a bit longer. So we can see that is or 1 to 3. So I'm risking one portion and wanting to make 3 portions. Just delete that. Are there any questions? We can make this a short session because I don't really want to put too much information into one session. You can text it or talk if you want. Otherwise, thank you everybody for attending.